Good morning, everyone. Welcome to this week's edition of AAMA Member Connect webinar series, Alternative Financing. Your host today is AAMA Executive Vice President, Pete Gustafson. Welcome, Pete.
Hey, Tina. Morning, everybody. And welcome and thank you for joining us for our 7th AAMA Member Connect webinar. My name is Pete, as Tina had said, Executive Director for AAMA. And joining me to assist with moderating today's event is someone you all know well, a former board member and president of AAMA, and current president of the American Amusement Machines Charitable Foundation, David Cohen. Morning, David. Today's program will include individual presentations from each of our 3 guest panelists, followed by a Q&A session until time runs out. Some of the questions were prepared and presented to the panelists in advance of this webinar, but our intent is to quickly move to those from you, the audience. You can pose your questions by typing them into the Q&A tab at the bottom of your screen. You may begin to do so now and throughout today's program. We'll do our best to get to as many as we can prior to the end of this webinar. If we're unable to get to your question, we'll provide an answer in the recap email you'll be receiving after the webinar. There will be a series of poll questions appearing during the presentation for you, the audience, to answer as well. The results of the poll questions will be posted during the presentation, so please answer them as they appear so we can show the results as quickly as possible. We're joined by 3 professional finance folks, each with a unique area of focus, including private equity, debt restructuring, and venture capital. 2 of these gentlemen have extensive histories in the amusement industry, while the third is bringing his unique perspective from the outside to the conversation. Let's meet our panel. He's the founder and CEO of Pivot Point, which provides investment banking and consulting services. He has significant experience with challenging business situations in need of strategic alternatives, capital, or creative business solutions. He also has exceptional professional and capital relationships. He has experience in entertainment, amusements, sports, media, direct marketing, retail, manufacturing, and related businesses. He held a series of management and executive positions at leading companies with an emphasis on ticketed entertainment and related businesses. He has 20 years of management consulting experience and is an experienced investment banker with FINRA and SIE certifications, as well as an MBA. He's registered with Old City Securities, an SEC registered broker-dealer and member of FINRA. He was a member of the International Association of Amusement Parks and Attractions Board of Directors, and he served as the chairman of IAAPA's Public Relations Committee. He received IAAPA's Annual Service Award for the most valuable service to the industry by an individual. You may remember him for delivering a compelling keynote address during our annual meeting last September, in which he spoke about how institutional capital has become involved in almost all aspects of the amusement industry. His opening address set the tone for what truly was a remarkable event. Please welcome Howard Kahn.
Pete, thank you so much. Thank you for those kind words. I'm pleased to be here today with you and with David, Ralph, and Josh, and have an opportunity to talk a little bit about some of the things we all should be thinking about during this unusual time. To kind of set the stage, I'd like to open with a quote that I've used often with clients as they're trying to think about what the new world will look like. And that is that ships don't turn at right angles. It goes without saying that we're in the midst of an unprecedented crisis. And as the days have gone on recently, we have several unprecedented crises. It's one that's hit the amusement industry very hard, and the US economy is really the biggest ship of them all and turns very, very slowly. The amusement industry, the entertainment industry, sports and hospitality, if you put it all together, is an enormous ship in its own right. And it's the core of how we live as Americans. It turns slowly like an ocean liner, but when it tries to turn hard, it capsizes. My belief is that it will take longer to restore the economy, the industry, and your individual businesses than most people anticipate. When we get there, I believe the economy, the industry, and your businesses will look different than they did pre-COVID-19. I believe it will take the balance of this year and throughout all of next year to reach a reasonable point of stabilization. Yes, I encourage each of you to think about January 2022 in your plans. So what do we think about today? We think about the fact that cash is king. And that is really interesting because the biggest companies in the amusement industry immediately secured large amounts of cash at the beginning of the COVID crisis. Six Flags, for example, secured $725 million in senior secured notes by mid-April. Cedar Fair secured $1 billion in senior secured notes by late April. And Disney secured $11 billion in senior unsecured debt by early May. Tillman Fertitta took a $250 million loan, and he added $50 million of his own cash to stabilize his businesses. What that tells us is that cash is king. So if you have significant assets and a successful business history, if you haven't already done so, think about accessing institutional sources of capital, whether they be debt or the sale of some of your equity. There is still a lot of liquidity in the market, and private equity and funds are making investments where they believe they are getting value. Consider a private equity fund as a new partner. There are funds that will make minority investments, for example, in successful mid-sized companies. There are family offices and wealthy individuals also looking for value-oriented investments. If you have not already done so, we suggest you consider government sources of capital such as PPP, the SBA disaster loans, and the like. Liquidity, the key point here is that liquidity gives you the time and the resources you need to turn the ship around. What do we do right now? It's a time to reevaluate everything. Your factory, your inventory, your staff, how and when your staff is paid, your facility, your marketing agency. How have you addressed your key suppliers, your key customers, other outside commitments? Are these expenses necessary now, or will they or won't they be necessary in the future? Can you replace what you terminate now in the future? My view is if it has a cost, especially if it has a meaningful cost, it's worthy of reconsideration. Occupancy and labor are always the two largest items, and we suggest you deal with those items first. It's a time to renegotiate outstanding contracts. Can you reduce your lease payments by 20%? Might your attorney convert a pending litigation to a success fee or part success fee and part cash? Better yet, can you settle it? Can you get needed services now and pay for them later? Make your assessments, identify the initiatives you need to take, communicate both internally and externally, and be prepared to pivot. The strongest suggestion I can make is to be frank and get in front of problems. Don't go to the landlord 3 months delayed in paying the rent. Go to the landlord at the beginning and try to negotiate a new deal. What else can you use the downtime for? You can use this downtime to lay pipe for more sales when things open up. Does your business provide a product or service that can be used by others outside of your traditional markets? How can you revise your product, service, and/or marketing? How can you make it better and be ready to go when things open up? Are there people you'd like to interview now as potential future members of your team? There's a lot you can do because you're slowed down from an operating perspective. Is your technology where it needs to be? How can you improve it? Can you use Zoom or other similar web-based programs in the future and reduce the time and expense associated with travel? Is a Chapter 11 necessary for your business, and will it help you get out from leases and contractual obligations? Or can you utilize what's known as an out-of-court 11? These are all things to be thinking about. And despite all the things that are going on, it's an interesting time to think strategically and to think about M&A, to think about your business. How can you better address the underperforming areas? Can you develop a true business plan to chart a course for the future? And yes, consider mergers and acquisitions. Might it, for example, be an appropriate time to merge with a complementary business? Would you consider selling to a competitor or a fund that values your business? Do you think it makes sense to acquire a competitor or a complementary business? Is there a business in distress you can acquire now that you couldn't acquire before? Is there a division of a larger company you'd like to own? These are all questions that we encourage you to ask. And now I'm going to finish by reading to you a quote. I wish it was mine, but it comes from Dr. Philip Levy, and he said, "Success will be the outcome of collaborative, flexible, and resilient companies characterized by empowered, engaged workforces. The virus is out of control, but how we manage it is completely within our control." Thanks so much for your time today, and I'm pleased to turn this back to Pete.
Thanks, Howard. Very compelling information. Our next panelist is a co-founder of EFA with over 30 years of finance experience, including more than 10 years of leasing and structured finance. Prior to forming EFA, he was most recently a managing director for GE Capital, where he founded and led the entertainment unions of the media, communications, and entertainment business. In this capacity, he was responsible for leading a team of sales and risk professionals that closed and managed over $3 billion of transactions to the entertainment sectors, including film exhibition in theaters, digital cinema, and 3D, the leisure industry, theme parks, ski resorts, FECs, and sporting venues, production, film, music, and video games, and casinos. I first met him in the 90s when he was with GE and I was working for Sega. He helped structure some creative finance programs for Sega, enabling us to achieve our aggressive business objectives. Welcome, Ralph Willis.
Hi, thanks everyone. Thanks so much, Pete, and I appreciate everyone joining us today. And I'm going to discuss the kind of a general overview of the lending markets and kind of breaking that down into various sectors. We often get asked the question, what are the lending markets doing these days? And it really varies by sectors within the lending markets. So when we think about the lending markets in general, I usually think about it in really 3, if not 4 different types within the lending environment. We deal with traditional banks, we deal with specialty lenders, and I'll go into those, and we deal with the REITs for our clients that own real estate, and we also deal with equipment lenders. And you know, the timing of this when I was approached for this webinar was very, very good. Our group at EFA, we were in the process of closing various transactions that were set to close in March and April. And 2 of those were with family entertainment centers. One was for a music venue and one was for a movie theater group. And you know, all of those deals were put on hold. And but since that time, and hopefully they all close down the way, but since that time, our group and myself, we've been constantly on the phones dealing with various lenders, dealing with the equipment financiers, and dealing with the REITs and really getting their perspectives. So we knew what their perspectives were pre-COVID, and now we have an idea of where they're heading post-COVID. And you know, just to kind of set the table for some of those groups, I mean, everyone understands the traditional bank market that's out there. Rates are down. The banks are typically a little less flexible, and they typically are requiring personal guarantees. The specialty lenders, they are more flexible. They typically lend more than the banks, and don't require PGs. But and they've been getting more and more involved in the entertainment area. And then the REITs, I think, as everyone understands, really doing sale leasebacks on new properties or existing properties. And then the equipment lenders. And all of them have had different perspectives going into kind of the lending environment, post-COVID, pre-COVID. All of them right now are much more cautious. We've been on the phones with all of these groups over the past several weeks, and all of them are more cautious right now. Looking at the bank environment, most of the banks were so involved in PPP loans, and now actually starting to look at the Main Street program, which is starting to take form. They're starting to, they were too busy before to really look at new deals, but we're really starting to see that open up over the last 2 to 3 weeks. We've been working with groups on the 7A program, 504 program, and we're starting to see that the banks out there are starting to review new opportunities. They are more cautious about what they're doing, but they're at least starting to open up. And same thing with the specialty lenders. We're seeing that they're looking at new opportunities. Once again, a little bit more cautious. And you know, as we look at those, there's going to be just more scrutiny on various parts of it. You know, they're really putting more scrutiny on lease properties and what that fixed cost is from rents. And we know that's been a big issue over the last 2 or 3 months, but they're looking at it even going further, and what it's going to look like in the future and how those rents could impact the business. You know, and we are seeing that lenders are looking for more credit enhancements now. So in the past, transactions that may have not needed a personal guarantee, you know, going forward, they're really looking for those, of the feedback that we're getting over the past few weeks. And we're also seeing that some of them are looking for additional credit enhancements, which may be in the form of interest reserves or rent reserves, so that they're really looking at ways that they can figure out what the business is going to look like in the future, but also protect themselves. You know, I think we're all seeing that post-COVID, that things are starting to at least see some normalcy, states opening up for business, but a lot of the lenders are still wondering what that means. What is capacity going to look like in the future? And is there going to be a second wave? So there's a lot of that going on as they're trying to figure out, you know, what they should be looking at going forward. You know, as we have been looking at groups and thinking about how clients can procure financing in the post-COVID world, you know, a lot of the same things that we looked at pre-COVID still exist. You know, there's more scrutiny right now, but lenders are really looking at what type of options that you'll have going forward. And they want to make sure, you know, as they're looking at it, they're really focused on 2 questions. And one can be, you know, what is your plan when you reopen, and how much is it going to cost for you to reopen? So as they're procuring financing right now, you really need to be well prepared with those questions, because it seems to be the first 2 questions that come up to get lenders to start looking at new transactions. You know, and a lot of times in the past, I think we've all seen where lenders have, you know, as you're looking at your trailing 12-month results and looking at potential add backs and you know, what would the add backs look like going forward if we kind of pulled out what the last 2 or 3 months could look like. And there might be room to put some add backs in as lenders are looking at your historical results, but many of them, you know, feel like there really could be a second wave and wondering, is this really a one-time event? And so there's just so much uncertainty going forward. So, you know, and then we're seeing lenders looking for additional conditions to funding transactions. You know, if there's going to be a funding that's over time, maybe it's an equipment facility where you're drawing down over time, or a construction loan where you're drawing down over time, the lenders are looking at the typical type of conditions to funding that they've had in the past. You know, no events of default and all those different types of things that we've all seen when we've taken loans down in the past. But now we're seeing other ones where states must be open for business for a minimum period of time. Maybe that's going to be 30 or 60 days. You know, if there is a loan facility that's getting drawn down over 6 to 12 months, they don't want to be committed to fund if there is something that happens down the road and states start closing up again. And hopefully that won't be the case, but we're just seeing that the lenders are being cautious and adding those types of conditions to funding. So it's really a case of, in this world, to make sure that you have a really set down plan. They really are going to dig into your business plan going forward. I'm not an operations person, but I have been reviewing plans that we've seen very, very recently as clients are preparing themselves to reopen and look for additional funding in the movie theater space, which a lot of our clients are in. Some of them are using a checkerboard type of seating philosophy where the black squares will have two seats, the white squares will have two empty seats so that seats aren't next to each other, or some of their ticketing systems are sophisticated enough so that as people are reserving seats, it automatically blocks out seats around them. You know, obviously, masks and cleaning and all those different things that obviously everyone's doing now. But in addition, we're seeing some of our family entertainment center clients, you know, looking at new ways to do things, maybe reserving time. We've seen that with a few groups where that everyone has to reserve a time, so that way they can limit how many people will be in the FEC at a certain time. And the feedback actually from the patrons has not been negative to that. They know that they can go in, they'll have a set time. Maybe it wouldn't be as crowded as it normally would have been in the past. So, you know, so there are some positive results from that. But it's really a case of, you know, that's obviously going to be something very particular to each venue. But the lenders are really honing in on that and want to really see what that post-COVID plan is going to look like. So hopefully that's helpful. And with that, Pete, I'll turn it back to you.
Sorry about that. Thanks, Howard. Thanks, Ralph. Beg your pardon. Thanks, Ralph. Okay, let's move on to our next panelist. He's an investment associate at Our Crowd, where he sits on the investment team and filters through hundreds of opportunities. Our Crowd is a global venture investing platform that empowers institutions and individuals to invest and engage in emerging companies. The most active venture investor in Israel, Our Crowd vets and selects companies, invests in capital, and provides its global network with unparalleled access to co-invest and contribute connections, talent, and deal flow. Our Crowd builds value for its portfolio companies throughout their life cycles, providing mentorship, recruiting industry advisors, navigating follow-on rounds, and creating growth opportunities through its network of multinational partnerships. With $1.4 billion of committed funding and investments in 200 portfolio companies and 19 venture funds, Our Crowd offers access to its membership of 40,000 individual, accredited, and institutional investors, family offices, and venture capital partners from over 183 countries to invest in alongside at the same terms. Since its founding in 2013, Our Crowd's portfolio companies have been acquired by some of the most prestigious brands in the world, including Uber, Canon, Oracle, Nike, and Intel. And with that, I'd like to introduce Josh Liggett. Josh, take it away. Josh, you got your audio off.
There we go. Thanks so much, Pete. Double mute going on. Really happy to be here. It's actually really interesting. You know, when I was chatting to the other panelists last night and before our call, you know, this is something that I've really never explored is the gaming industry, which is really interesting to hear. And it's amazing. You know, what I get to do every day is really learn. And what's amazing is to learn about something new. But the perspective that I'd love to bring, first of all, is from the venture capital perspective, as well as from the technology perspective, because that's what I work on. And basically what I'm here to tell you is most likely it's a really bad idea for you to take venture capital funding right now. Most companies, you know, that you might be thinking, oh, maybe I've heard about a lot of VC. I've heard about these mega funds, these billion-dollar funds, even hundreds of billions of dollars. If you're talking about the SoftBank Vision Fund, you know, maybe I'll go talk to them. But venture capital is very different. And what I like to talk to a lot of very quickly, you know, I like when I speak to, you know, we look at hundreds of companies, you know, every probably a month, honestly, from different parts of our funnel. And a lot of companies, I ask them, do you want to be a business or do you want to be a startup? You know, a business, you know, grows quick, grows very nicely, has positive earnings, everything's going well. You know, a startup, you know, the word that we use is burn. where companies are burning money and instead of opening, one lemonade stand every year for 3 years, it's I want to open up 300 lemonade stands, in a month. And what you see, VC in two charts, the first one, which is already up there, basically tells you that, if you look at the bottom, that's the return of a fund. What multiple are you returning? So if it's $100 million fund, are you, the people all the way on the left are returning, less than $100 million, and the people on the right are returning more than $500 million. And what's surprising is the fact that the middle of the road has a lower failure percentage in terms of startups that fail than the people on the right, because what they're going for are transformative technologies that are here to disrupt the world, and just, things like Zoom, companies like Uber, Airbnb, etc. And the next chart is sort of our Bible, which is what's called the power law, which is going to come up in a second. And the power law basically states that, a very, very few of our companies are going to have a big returns. Tina, can you pop that up? The other chart. It's all okay, fine. So basically, it'll come up in a second. Basically, what the power law tells us is that, one or two investments are going to have a huge, huge, huge return. And the rest are, not going to have as great a return because there's going to be a huge failure rate among startups. So, that's what when we look for a company, we're looking for tremendous growth. We're looking for that sort of thing. So for a business that's looking to grow, slowly, nicely, it's funny. We try to do, someone asked me if I ever did a DCF on a startup, and, it's problematic when, for the next 3 years, they're losing money every year and hoping for, investments from the other side. And then, with stuff, so you can't really do a DCF. You have to use other valuation metrics. But what we're really trying to do is look for tremendous growth, from a few companies, and hope that goes from there. But what I did want to talk to you about is the technology side of things. Because there's a lot of technology out there that people may not be aware of. Company, in all sorts of areas. The area that I sit on is in fintech. That's really my area of expertise. While I work on companies that work in AI, big data analytics, all these, every area you could think of, health, not really so much in the healthcare industry, but data providers to healthcare. There's a tremendous amount of information and technologies that are, and companies that are there to help small businesses like, many of the people that are most likely on the call right now. So one area is payments, that has a lot, that's a great thing. Small business lending is another area. The third area is sort of something like connectivity, I would call it, APIs, which not many people may know about. It's something really, really cool. Basically allows, you to connect a business or anything to connect easily to somewhere else. A great example is if you've ever used LinkedIn or Google to easily log into, another application, that's using an API. And the last thing is small business, sort of back office CRM pipeline. And I just want to run through a few technologies in all those different spaces, a few companies in all those different spaces, telling you sort of what's been happening out there and all the amazing thing that's happening. So in payments, there are three real big companies two real big ones and one that not everybody knows about. The two big companies, one is Stripe, which is a private company. One is Square. Both of them deal with payments, whether it's point of sale payments, whether it's digital payments. The other one is a company called Adyen, which I imagine not many people know about. It's a public company based in Amsterdam in the Netherlands. It's on the stock exchange in the Netherlands right now. It's in the valuation of the tens of billions of dollars. They process payments for Uber, for a lot of other companies. I think EasyJet was one of them, a lot of other ones. That's one thing that they're providing. And, the poll question coming up is, there's a lot of digital technology out there. The question is if people are aware of it. The next area is small business lending, which there's a lot of really, really amazing fintech companies out there. When I was cutting my teeth, in the schmata business in New York, working in the clothing business, I was there in 2008 when the factors and the lenders became a lot more rigid in terms of what they were requiring. And out of that came the use of artificial intelligence to better assess the standing of a business, where it may be that the business is being denied a loan or denied a line of credit by a factor, but theoretically they could be seen as having something, a more interesting technology, or a more interesting to provide more interesting, solutions to businesses. And that's Blue Vine, Cabbage, and Fundbox are all companies that provide small business loans, factoring, all that stuff. Actually, Cabbage, I just saw recently, actually today, that they've already provided to over 100,000 businesses, PPP loans. I think it's over like $3 billion is the number. So they're available, as alternative financing, for small businesses as well. The fourth thing is there's a company, which is probably my favorite company that's out there. A company called Plaid, which some people call it Plaid, but it's called Plaid. Plaid is basically lets you connect to anything. It's all about interconnectivity. They were just bought by Visa for, I think $5 billion. I want to say it was between 3 and 5 billion. Very, very amazing company. They actually have a partnership now with Microsoft that allows you to connect Plaid and their whole system of open banking and open finance to connect to us. Only 2 people know about Cabbage, so I'm happy to hear that we told some more people about some really cool technologies. But Plaid basically allows you to connect Microsoft Excel to all sorts of areas out there, which for small businesses is really, really important. And last but not, and I could talk for hours about Plaid, but that's for a different time. And last but not least is Back Office CRM, which is there's a really cool company that we've actually invested in, to be perfectly transparent, called Honeybook. Honeybook is basically, think of it as Salesforce, except for a solopreneur or a small business. You run your entire funnel through Honeybook in terms of any sort of needs for advertising or inside sales. They use connections with a lot of other companies that I could go down the list, including Stripe for payments. They allow everything to really go inside of there, so it's a one-stop shop basically for solopreneurs to to be working, have a back office to work on. I could go on for hours and hours about technology. Would much rather have it open for questions if anyone has specific questions about technology or any other areas that people are looking in. For example, Zoom is something that we're using right now. We've been using Zoom at our crowd for the past 4 years. So, it's something we've been very used to. And we like to think of ourselves, especially in the venture capital world, as very much being on the front end, the cutting edge of seeing what new technologies are coming. So we'd be more than happy to share either in this forum or a different forum, any questions about adopting new technology. And thanks so much. Send it back to Pete.
Thanks, Josh. Okay. We are going to move now into the question phase. And I'm going to hand that over to David Cohen to handle. But before we do that, I want to remind the audience, you've got some real talent on this panel who can talk to you about what's going on in the world of finance in this COVID world we're in. So please enter your questions at the bottom of the screen using the Q&A tab. And with that, David, I'll hand it over to you to start pitching some questions to the panelists.
Thank you, Pete. And good morning, everybody. Thank you for joining. Want to thank the panelists for their time today in preparing. So I've got a couple of questions, and I'll direct them specifically to the individuals because we have a broad base of subject matter experts here. And so, Ralph, I think this is one for you. We've heard some chatter around the CARES Act Main Street Lending Program. Are you aware of any guidelines that have been finalized and what they might look like? Is there anything that you can bring to the table to let us know where that is and when we can expect that to be part of, our opportunity to take a look at?
That's a great question, and one that we've been asking the lenders that we've been dealing with. And the short answer is a lot of the lenders still aren't sure if they're going to be part of the program. There's certain things that they need to register to be part of the program, and they're still trying to see if that program, how it may change. Some of the feedback that we've gotten from lenders is that they're looking into it and trying to see if the program could potentially be changed. The way it's written right now, everything is a 4-year loan. And depending, there's 3 different parts of the Main Street program, and depending which part of that you're in, the amortization can be relatively high. And so some of the banks are pushing back on that. But that being said, we probably went out to 10, if not 12 different lenders to see if they were going to be a part of it. A couple of them decided not to be, but the rest of them are either looking into it or have decided to be part of the program. So it's really just taking shape right now, and hopefully some of those lenders will be able to use their clout a little bit and push for what will hopefully be a better program.
Okay, great.
It could be a little longer term and have a little bit of less amortization. And again, the amortization varies depending on which of the 3 parts of the Main Street program you'd be involved with.
Great. Thank you, Ralph. Tina, could you post the polling question with regard to funding that we wanted to put in front of the participants? So it's a 2-part question. We'd like to know if you've applied for PPP and where you kind of stand today so that we can get a sense of what's happening. And so while you're doing that, thank you, and then we'll put that up for the panelists to be able to see. So Ralph and maybe Howard, you touched on it briefly, given the new normal that we're expecting. What do you think lenders and investors might be looking for specifically today that business owners and people should be thinking about when we're trying to attract either new loans or new invested capital into our businesses?
And Howard, I'll go ahead on the lending side, and I'll let you talk about the investor side. On the lending side, I touched on it a little bit. I mean, there's so much more scrutiny on the industry right now. We have spoken with some lenders that are just not ready to do lending into the entertainment markets, and our clients are, a lot of them are family entertainment centers, a lot of them are in the movie theater space, and we're seeing some pushback from some lenders, but other ones are ready to get back in business, and I think that they'd like to see this as an opportunity for them to maybe get some business that they wouldn't have had in the past, because maybe there is a little bit less lending competition right now. And as I mentioned, with the scrutiny that's there, they're really looking at business plans and trying to figure out who has that long-term business plan. What are the projections that people are looking at, and maybe to touch a little bit on what Howard had mentioned, they're not necessarily always looking for just a rosy picture. They want to know what you really think the business is going to do, how it's going to ramp up, what the plans are to potentially grow the business, and they're asking those questions very, very specifically, as we're seeing. So they don't want to necessarily see high-level answers. They really want to see that you've looked at it, you know what your pre-opening costs are going to be as you're reopening your businesses, and how that could be affected if there is a second wave or anything of that nature. So it's just really being prepared is the best way I can say. And we're seeing that from the banks, the specialty lenders, the REITs, and the equipment financiers. They all have credit committee people that are of the same mindset, and they really want to know what the business is going to look like in this environment going forward.
So, Ralph, I agree with everything you had to say. Maybe to add a couple of things and amplify on a couple of things. First of all, to some degree, it depends on who the investor is. So the larger institutional capital funds will be more structured. A family office, for example, will have more flexibility to be able to look at a particular situation. But some of the things that they're also taking a look at are assets, either the business's assets or the principal's personal assets. They want to see, when we're back in business, right, how you're tracking against your history. So if how you're moving that forward, and are you suddenly doing the same numbers that you did before? Are you even doing better? Or just how are you tracking? Because a lot of history is no longer relevant in terms of underwriting either a loan or an investment. And so we have to look forward a bit. And then they always look at the track record of both the business and of the individual that's leading it or the senior management team in whole. And track records are very, very important. And so it's important to be able to project that. You know, there are intermediaries like Ralph and I that sort of help shape a package and understand what the lenders and investors are looking for. And that's the area, and we understand where they have interest in more flexibility. There will be more lending. Obviously, as I mentioned earlier, the big companies went out to the capital markets right away, and they were able to secure significant money. To the extent that someone is also able to make a personal commitment alongside the lender or investor, that gives them more comfort. So just like Tillman Fertitta did, he put 50 million up. This is public information. The Jeffries put up 250 million and organized a consortium of lenders. And there was comfort because of the investment that Tillman was going to make in his businesses.
Yeah, if I may, to one point that I should have made, you know, this is experience on deals that we're working on right now. We've had two transactions. One's in the movie theater space, one in the family entertainment center space. Both relatively large companies that had a good track record. And as they're looking for debt coming back out of this, you know, their banks just aren't open for business, or at least not ready to jump in at this point. So we've had to, what we would have in the past been going to the bank market, for those clients, we've had to shift and go to the specialty lender markets. More expensive, more flexible, but you know, they've just had to, they realize that right now the banks aren't as open for business. And so they've just really had to shift to a different part of the lending chain, if you want to consider it that. So just wanted to mention that as well. It's just kind of a different way for people to think about things if the bank market isn't where they need it to be at this point.
So Ralph, what you're actually saying is paralleling in the investor market, because, you know, it's more difficult to get it through the institutional guys right now. And therefore people are moving towards family offices and other forms of less traditional, less structured capital.
Yeah, Pete, if you have a couple questions from the audience that you would like to pose to the panel. Pete, your microphone is off.
Rookie mistake. There's a couple questions coming in from the panel, and I'm not sure who would be best qualified to answer, but it's one is, are there any lending options for locations in Canada? Many of the programs being discussed only apply to the US. So in Canada, is there anything, do you guys do any business in Canada?
Our side, yes. We do business in Canada, and pretty much any of the groups that we're speaking with on the specialty lender side, they'll look at deals in Canada and in the US. Some of the banks have more narrow footprints and don't go into Canada, but the international lenders do. And some have a large presence in both areas. And in some respects, when we've done Canadian deals, we've also just reached out to some of the regional banks in Canada as well. But yeah, the options are there. We see the equipment financiers, specialty lenders as well doing across the REITs, typically not. The REITs are more US focused, but yeah, there are options.
And on the investor side, what you'll find is, we didn't talk about strategics, but you know, in our business, for example, Ripley Entertainment is actually owned by a holding company, the Jim Pattison Company, which is a rather significant $10 billion a year company. It's based in Vancouver, and they have the capacity to make additional investments. So there are strategics and there are funds, and it similarly mirrors what's going on here in the United States. But the strategics do have capital. They're going to look for bargains.
Yeah.
In terms of, and I got a quick one. In terms of small business loans, we invested in a company called Wave, which was bought by H&R Block, that is based in Canada, and they're for a couple $100 million, I think. And they're specializing in basically similar to Cabbage, Fundbox, Bluevine, all of them, and they're based in Canada. So they're doing a lot of invoice factoring, so it might not be applicable necessarily to everybody. But that is another option that is out there.
Thanks, Josh. You mentioned the SBA. There's a question from Kenneth Wynn who says, will the SBA be doing any special financing for new business startups? Are you guys able to speak to that?
Sure. Well, I mean, specifically to, and I can take this from a couple of different angles, but we're working on SBA loans right now for new construction, for brand new businesses that are opening their very first site. So it's a very first family entertainment center. And one of those is in Florida, one's out in Arizona. We do have SBA lenders that were interested in the transactions pre-COVID and continue to be interested right now. Their processes have been delayed because those banks had to focus on PPP loans and everything else within their portfolios. But now as we're coming out on the other side of it, we're engaged again and working with those groups to do construction financing for venues that are in kind of the $5 million range. And we've had feedback from two different lenders that have said in some respects, they like doing construction loans for new businesses more in the current environment than potentially a more mature business, multi-venue business, just because the venue won't be opening. If it's construction financing getting now, right, the venue won't be opening for 9 to 12 months. And so at that point, if the project is still moving along, the principals are putting in their equity, and typically it's the equity going in before the debt goes in. So, so I think the lenders get comfort that if the principals continue to put their equity in, they continue to move forward with the project, then they'll be able to fund that project down the road when hopefully we're in an environment that has a more semblance of normalcy than we have right now.
Ralph, thank you. I'll add a little bit of color to that. Even though I'm not in the lending business today, I have been for 35 years. I think that you need to find a specific SBA lender that will have the appetite to engage in a startup. But I also believe, to Ralph's point, that there will need to be typically some hard assets. So unless there's a construction or a piece of real estate, my guess is that it will be a hill to climb for you if there aren't any hard assets backing a startup with the SBA. So and that may change, based upon some of the programs that are coming out in the future that are going to be sponsored by the government and run by the SBA. But you'll need to really work hard to secure that funding.
And if I may, on one of our projects right now, we've had to get a little bit more creative where the SBA lender still likes the project, but didn't like how much exposure they would have, how large the transaction was or is. And so in that specific regard, we've done an approach we hadn't done before with this type of early stage financing, where we have an SBA lender that's doing the construction of it and doing a typical SBA 7A loan with doing the construction, but they're not as interested in the equipment, and so they're allowing another lender to come in and do the equipment piece of it. So they'll basically, between the two of them, it's enough dollars for the principals of the project, and it's just not really an approach we had done in the past, but we have to be a little bit more creative these days.
Yeah. So I'm going to ask an open question for the group, and then Pete, I think there's some others from the participants that we can pop up there. So the question is really about opportunities. So the landscape is changing. It's happening. It's happening as we speak. We're seeing companies like, JCPenney close its doors. We're going to see a lot of big box retailers not be around on the long term. And so from a commercial real estate side, there's going to be a lot of opportunity for all types of business to take a look at how they take advantage of that. So the question for you guys is, what opportunities are you seeing out there? What's the buzz out there? Are people willing to be more thoughtful about, the use of that real estate to the best of your knowledge? And, what do you think, what other opportunities that you might be seeing for this industry to think about?
I can jump in if everyone's we're seeing, a little bit to what you were saying, David, but we are seeing, we've been approached by, and Howard, you can jump in on this one, but we've been approached by 3 different groups, one strategic, 2 more private equity groups that are looking for opportunities right now. And so they're thinking that if there were businesses in the past where maybe the principals, the owners weren't thinking about selling, they're thinking maybe now is a time after all of this that they may be more interested in selling. And so not that they're necessarily saying we're going to pay, a much lower multiple and it's a fire sale situation. They just think that there could be some groups that maybe they've owned their businesses for many, many years and might be just more incented to sell after this, and they're looking for those opportunities. So we're seeing that on that side of the business. Howard, I don't know if you're hearing kind of the same.
I'm absolutely seeing it on the private equity side. I'm involved next week with my firm, and we're presenting 6 funds who are all very actively looking for new investment opportunities, both in the space and outside of the space. Pete, you mentioned JCPenney, for example, and I think what we're going to see in the marketplace is a lot of companies that really had fundamental balance sheet and income statement weakness, right? They had too much debt. Their businesses were no longer competitive and were failing. There's a shifting consumer sentiment, in the way in which consumers transact and use the web. And so those are the businesses that can't sustain during this, and you're going to see some of them go away. Other businesses will come back. I do think that the period of time on the comeback will be longer, and it'll be longer for a bunch of reasons. Consumers will have less discretionary capital. Some consumers will be concerned about being in crowded environments. Some facilities will be concerned about allowing too many consumers into an environment that becomes crowded. And all that blends into some real strategic thinking about the future. And, to Ralph's point, there's going to be a period of business sales and also some merger and acquisition opportunity where businesses realize that they'll do better if they're under a common building with a single CFO. It's too hard to sustain too many small businesses, but when they group together, they have a much better chance. That, of course, involves some streamlining of staff and overhead and so on. But I think each individual has to look at their own business and their own personal situation and those variables that they can control. And then do that in conjunction with, depending upon what their capital needs are. Do they go to the markets? Do they go to the SBA? Do they go to the banks? Do they go to the specialty lenders? Do they take in a private equity fund as a partner? Do they, sell a large interest in their company? Or do they take in, there are funds today that will invest in successful companies, large amounts of minority capital. They've done some work in the amusement and entertainment and coin-op space, and they too are actively looking for new deals.
From a technology side and from sort of the startup side, we're definitely seeing a tremendous amount of activity. We're still seeing, we're seeing term sheets getting filled, issued. We're seeing it's still as active as ever before. On the business side, you know, the big word in startups is pivot. You know, where companies one day we're doing one thing and then we're doing, you know, another thing tomorrow. A lot of companies have been pivoting, you know, their solution to be in the trend of COVID, because that's quick money, easy money, all that stuff. But, you know, when you look at like the big companies in the world, one of my favorite companies to look at is Amazon. When you think about what Amazon has done, as you know, when they first launched and they were doing books and music, if I would have told you, you know, in 2000 that they'd be one of the largest providers of cloud storage, you know, and that would be one of their core businesses. First of all, you wouldn't know what cloud storage is. And second of all, you know, it's like, why would a book marketplace get into like software cloud storage? It's because that they saw that this is a trend that's happening, and you know, and we're going to jump on it, and we want to stay ahead of the curve. And that's why, you know, Amazon is Amazon, Bezos is Bezos, you know, and it's been the same thing with Google, with Apple, with, you know, with the big companies. And the CEO of Microsoft, you know, he mentioned that I saw the quote that there's been something like he believes that there's been 2 years of tech adoption in the past 3 months. And that just, you know, people who weren't comfortable shopping online, you know, are now okay to shop online, groceries, or use Zoom or use WhatsApp. Now they're becoming comfortable with that. So it's a question of with this new reality, how can you adapt your business to that? You know, a good example is in the sport, you know, to use a parallel to what's gone on in the sports tech industries, is for many years, you know, it's much more, at least with football, for example, it's much more comfortable to watch football at home than at the stadium. So it's a question of, you know, the stadiums are trying to ask themselves, how are they going to create an experience that's unique, that can compete with the at-home experience, the comfort and the price of working from home. And, you know, that it's sort of a question, it's a hard question, and it's not easy to answer. And it's sort of a question of what tools can you use, whether it's branching off into different you know, go-to-market strategies or different applications, whether it's AR, VR, all sorts of different things that can help sustain your business as people are getting more comfortable with technology going forward.
Josh, you made
Pete, do you have?
Well, let Howard have a finish up. Go ahead.
I'm sorry,
ahead,
Josh.
Howard, sorry.
No words. You made the comment about pivoting, and two comments about pivoting. So my company is called Pivot Point, and it was not created at the time of this crisis. It was created in the middle of last year, when I was thinking about companies that need to turn and they're at a point of inflection. But one of the most important points about pivoting is that a person or an entity keeps one foot firmly on the ground, right? And then turns the rest of their body. So
that's not a pivot, yeah.
Or turns their entity, right? So, you know, they say stick to your knitting. So to your point, Amazon stayed to its core business, but then turned and figured out how to use its core business and how to use its platform to advance itself. And that's so important today, especially, so we have folks that are listening that are in the amusement industry and that make games. And where can you put games that you haven't put games before, right? What's an appropriate place where there's traffic and there'll be participation, and start to think about how can you use that manufacturing capability to make something other than games. For example, I noticed that Bob Space Racers, who makes the group games down in Florida in Daytona, they've created sanitary stations with a foot pedal so that you can walk up in the amusement park, press the pedal, and then get the hand sanitizer on your hands. You know, that was a pivot. They're in the group game business, but they figured out very quickly how to use their manufacturing capability and create another product that would sell.
Thank you. Pete, any other questions from the participants that you'd like to pose?
I'll go with one more, and then unfortunately we're up against the clock, so we'll have to get these other questions answered and in the follow-up email that'll accompany the recording of this webinar. And this one's from Rich Babbitt. He's considering raising capital by selling a piece of real estate. Have you heard of any waivers of LT capital gain taxes?
Waivers of what?
Long-term cap gains.
Yeah, long-term capital gains tax.
I haven't heard of it.
Yeah, I wish.
Not to say that it's not happening, but it's just not something that I haven't seen Josh, Howard, I don't know if you've heard.
They're going to have to somehow figure out how to pay back all the debt from everything they were doing. So I imagine that it's going to go in the other direction. But
Yeah.
We're in the midst right now of hopefully closing 2 different sale leasebacks for our clients and their real estate. And we just haven't seen that as something that's been mentioned thus far in that process. Again, that process has been delayed now. Those were part of the deals that we were trying to close pre-COVID.
Yeah.
And so we're getting re-engaged with those groups right now, but it just hasn't been something that we've seen, but we can definitely look into it.
Yeah, I'm unaware of anything of that nature. I do know that if you're exchanging a piece of real estate for another piece of real estate, you could have the opportunity to defer the tax associated with that, but it has to be a like-kind exchange in order for that to, in the past, to take advantage of that. But it would have to be real estate for real estate. So
Yeah.
All right. So I want to thank both Ralph, Josh, and Howard for their participation today. While we've spent an hour today, today didn't happen in an hour. So I appreciate your willingness to participate and collaborate with us and joining us in this series of webinar. Also to the staff of AAMA, Pete, Tina, and Alex have done a fantastic job keeping us apprised and informed and putting this together. We wouldn't have been able to do this without them. And to all the participants, thank you for joining us today. We wish you the best. Stay safe, stay healthy.
Thank you.
David.
Thank you, everybody.
Thanks, gentlemen.